Is General Electric stock a buy right now? That's the question I'm going to answer in this video, looking at the company's revenue growth over several years, looking at the profitability, and then finally looking at valuation to determine if the current market price is attractive for GE stock investors to buy. Now, of course, General Electric was one of the top 10 vote getters in my channel member survey last week. If you didn't already know, my channel members get the privilege to vote on which videos I create in the week ahead, and General Electric was one of those winners, one of the top 10 vote getters, and that's why I'm making this video here today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So there are a few reasons why investors are getting more excited about General Electric stock. The company's made recent innovations in engine design and engine technology, and it's winning customers, and it's gaining traction in the defense industry, competing against Boeing and Raytheon for huge government contracts. Furthermore, looking back to 2022, you can see the company stopped its declining revenue it was experiencing since 2015, when its revenue fell from 116 billion down all the way to 29 billion, and recently it's recovered from 29 billion up to 44 billion. And given those recent wins in engine technology and aerospace design, investors are excited that General Electric could continue increasing revenue for several years into the future. In addition to improving revenue growth, the company has also been improving its profit margins, again reversing that trend from 2005 to 2016. Its operating cash flow to sales ratio fell from 28% down to just 1%, and since then it's bounced back, growing all the way back to 17.2%. So in recent years, General Electric has done well to return the business to growth and improve the company's fundamentals, both on the top and bottom line. Now, that's also led to an improving return on invested capital. This measures how good a management team is at utilizing resources to build products and services that customers purchase and generate profits and cash flow for the business. GE has improved its ROIC from negative 0.3% in 2020 all the way up to 7.6% in the most recent trailing 12-month period. Now, while the trend is improving, and that's a good sign, the absolute number at 7.6% is not very attractive, and it's not very attractive when you compare it to the company's weighted average cost of capital, which is above this number of 7.6%. So you'd like to see the company continue to improve these metrics in order to generate shareholder wealth. Typically, what you'll notice is a company is adding shareholder wealth when their return on invested capital is greater than the weighted average cost of capital. But sometimes you'll see companies like General Electric that will experience temporary declines that will cause their ROIC to fall below their weighted average cost of capital. And sometimes growth companies will have a negative ROIC as they're building their business to grow, and they have yet to generate profits to generate above their weighted average cost of capital. So this is more of a metric you look at over the longer term rather than a metric you look at a single point in time. And with General Electric, it's encouraging to see the company's improving its ROIC meaningfully over the previous several years. By the way, these charts that I'm pulling up are from Fiscal.ai, my preferred data provider. There's a link in the description if you're interested in using these kinds of charts for your financial analysis. So General Electric valuation now, it's trading near the most expensive it's been all year long, and relatively expensive when looking at the S&P 500 or when looking at comparable companies or when looking at its historical averages. Is trading at a forward PE of 45. Furthermore, when I evaluate the business utilizing my discounted cash flow valuation model, which I updated today, the intrinsic value per share comes to $139, whereas the current market price at $304, General Electric stock is trading near its 52-week high of $317, and it's trading nearly over 2.5 times the intrinsic value per share I calculated. So whether I look at this business on my proprietary discounted cash flow basis or whether I look at it on my forward price to earnings valuation, the business looks expensive. And so to answer the question, is General Electric stock a buy right now at current market prices? I would say no. I would rate this business as a hold and not a buy. Hey, if you value my process for researching stocks, I think you'll appreciate access to my spreadsheet containing my discounted cash flow valuations, which calculate a fair value for over 200 companies. It answers the question, what's a good price to pay for a certain stock? You can get access by joining our channel at the investor tier or above. See the link in the description or click the join button below to learn more.